A financial plan with proper direction will help you manage and grow your wealth without any investment mistakes. We have Amit Grover, financial expert, with us today to explain financial planning tips for beginners. Amit, over to you.
Today's topic is about the art and science of financial planning. Why I am saying it's science? Because there is a lot of maths which is involved. And why I am saying it art? Because there's a lot of things which are very person specific. Because at the end of the day, personal finance is more personal and less of finance. We all have unique goal, unique circumstances. So obviously a lot of art is also involved. There cannot be a ready-made plan for everyone. Okay, every plan has to be unique based on every circumstances. So let's start with a very basic thought in terms of what is planning all about and how do you start the idea of financial planning. So basically, which is the most important thing, and surprisingly, majority of the investors don't do it. They just randomly invest into stocks, mutual funds, FDs, real estate. The idea is first thing which every investor has to do is define their goals. And what do I mean by defining their goals? Basically, it's not about visual thinking. Okay, people say I want to travel across the world. That's visual thinking. Okay, idea is you have to have real clear goals in terms of what you want to achieve, how you want to achieve, and what are the importance of each goals. I'll tell you. So basically, you have to come to the reality. Okay, we have to have a reality check in terms of whatever are important goals. So let's start with a very basic thought. And I've just put down few of the important real goals which people generally have. Let's say you want your son or your daughter to go for education. Okay, the annual fees, that's a real goal. You want to go for a vacation with your family, that's a real goal. You want to buy a car or upgrade your car, a real goal. A home decor, a real goal. Your children's marriage, a real goal. Maybe obviously your children's higher education, a real goal. Buying a house is a goal. And most importantly, retirement, okay, is a very important, extremely important real goal. In fact, a lot of people, when they do financial planning, they keep retirement, okay, at the end, which is actually very wrong, because retirement should be the first goal in financial planning. And why do we say that when you are doing your financial planning, retirement should be your first goal? Let's do a simple maths to understand the entire stuff. Let's say you retire at the age of 50, 55, or 60. And we all know we will live very long. Let's say we live till the age of 80, 85, or 90. We will have a 30 years of zero income life. I'll repeat this point because I want this point to get sink in your brain. The idea is, let's say you retire at the age of 50 or 55, or let's say 60. Now, let's imagine, okay, and most of us will live very long because the mortality of India is increasing. So let's say we live till the age of 80 or 85. 55 to 85, it's 30 years of zero income. So when somebody is doing their financial planning, retirement is an extremely, extremely important role. In fact, the financial planning should start with retirement. Then obviously buying a house, maybe if in case somebody wants a house, your children's education, their marriage, and various things. So the first thing which we recommend all the clients is to define their goals and prioritize their goals. When you are prioritizing your goals and writing down your goals, you have to understand that the value of goods and services are only going to increase. Two reasons. First is inflation, which is called Mengai. The interesting point is, if I just go back and look back at life, I did my entire engineering at 35,000 rupees. Today, what I know that the cost of 1 year of engineering is around 1 lakh rupee. So basically, this is what inflation is all about. Prices of goods and services will only increase. That's first. Second thing is that if you do a simple maths, you also understand our standard of living is also increasing. What we used to find things as luxuries 20 years down the line, today those things have become necessities. And today, what we think as luxuries, trust me, after 20 years, those will become as necessities for us. So our standard of living is also increasing. Inflation is also there. And that's why it is very important to define your goals and always remember retirement is your most important goal. So once you have defined your goals, okay, now you have to start with the process in terms of understanding the asset classes. And then I will talk about how do you find the risk and what is your risk. We'll discuss about that later, the maths and the science part. and the art part, we'll discuss that later. So now you have defined your goal, okay? And now let's try to understand two primary asset classes which can help you achieve these goals. So the first primary asset class, the name is equity. What is equity in a very simple terms? Equity means investing into businesses. And all these businesses, whether it's in India or internationally, all these businesses are in front of us. We use these goods and services on a daily basis. Like when you get up in the morning, you brush your teeth, it's Pepsodent or Colgate, or you have atta, it's ITC Ashirwad atta, or when you go to a bank, it's HDFC, ICICI, Kotak, or when you go for shopping, it's DMart, Shopper Stop. I'm doing this session right now on Airtel Broadband, a listed company. You take a car, it's Maruti, Mahindra, Tata Motors. In Diwali, you will obviously pay, you'll decorate your house, okay, and you will use paint. It's Asian Paints, Berger Paints, Nerolac, or you will use cement. It's ACC, Ultratech. So basically, all these companies are in front of us. So basically, what is equity in simple terms? Equity means investing into businesses, as simple as that. And businesses create wealth over a longer period of time. What do we mean by creating wealth? Equity has the potential to beat inflation over a longer period of time. So now let's try to understand the journey of both the asset classes. So basically, firms can raise capital by two things. First, they can take capital, and that's called equity. So you become a part owner in that company. The second is basically fixed income. Firms borrow money and they will give you principal and they will give you interest back. That's basically called as bonds. Let's try to understand the journey of both equity and fixed income. So the above journey, what you can see is predominantly the journey of fixed income. It actually, the returns are good, but the returns are very safe, but the returns will not be able to beat inflation. So over a longer period of time, you will realize that the returns of fixed income will not be able to beat inflation. On the other hand, equity, a very interesting asset class, it goes through periods of ups and downs. It has a potential to beat inflation over a longer period of time. So a lot of people generally ask, what is good? Which is more risky? So now if you are investing into fixed income for a short period, then it is very safe. But if you are investing into fixed income for a very long period, then fixed income is very risky because it will not be able to create wealth and it will not be able to beat inflation. So fixed income is very risky if your horizon is long term, but safe if your horizon is short term. On the other hand, equity is very risky if your horizon is short term, but it's very safe if your horizon is long term, because in long term, generally equity market gives very good returns. Now, just to explain you the returns of equity and fixed income, let me talk about equity first. So Sensex is nothing but the top 30 companies of the country. It started back in 1980. Today, the value, okay, the index started from around 10,000, from 100 index. Today, as we speak, the index is around 58,000. That means a 1 lakh rupee invested back in 1980, the value today is around 5.8 crores. Let this point sink in your brain. A 1 lakh rupee invested back in 1980, the value today is 5.8 crores. That's the power of equity and equity mutual funds to create wealth over a longer period of time. But the journey of equity market is always volatile. What do we mean by volatile? It goes through periods of ups and downs. There are good times in equity markets. There are bad times in equity markets. There are horrible times in equity market. There are amazing times in equity markets. So the journey of equity market is like a journey of a businessman. You will always have good times, bad times, horrible times, amazing times. There are journeys always full of ups and downs. On the other hand, the journey of a fixed income investor is a very straight, very conservative, moderate line. Yes, it is very safe, but over a longer period of time, it is not able to create wealth. Now you might ask a question, which asset class is good? Is equity better or fixed income good? And the answer is, let's not compare both of them. Both of them are good for your portfolio. You need to have a combination of both these asset classes based on your goals and based on your risk appetite. Now you might ask a question, how do I find my risk appetite? How do I come to know, okay, what is my ability to take risk? I have just listed down 4 important things and I'll give you examples. How do you figure out how much ability do you have to take risk? The first and the foremost thing to decide your risk ability is to look at time horizon. Let's say you are 30 years old and you are thinking about your retirement, which is 30 years down the line. So obviously you've got 30 years time frame to invest. Your time horizon is very long. You have amazing time horizon. Your ability to take risk increases. Let's say you are 30, 35 and you are thinking about your children's higher education. You have got 20 years horizon, amazing time horizon. Your ability to take risk increases. Let's say husband and wife both are earning, okay, and they're earning very well. So obviously, since there are two sources of income and both are earning very well, your ability to take risk increases. Now let's say you get good amount of inheritance, or possibly you will get good amount of inheritance. Since you have a lot of capital with you, your ability to take risk increases. So now let's say if your horizon is like, let's say 3 years or 4 years, your son or your daughter is will be getting married, or they're going for higher education after 3 or 4 years, your ability to take risk is very low because the horizon is only 3 years. You should not take risk. But let's say only you are the only earning member in the family, then obviously your risk-taking ability comes down. Or maybe if your income is not very stable, your risk-taking ability comes down. If your health is perfectly fine, okay, your risk-taking ability increases. But if your health is not great, your risk-taking ability comes down. Okay, if you're not getting any inheritance, but you have a lot of liabilities, like let's say you have a housing loan, then what happens? Your risk-taking ability comes down. So basically, risk-taking ability is a function of a lot of things: time horizon, what is your source of income, how many people are there in the family, are you getting inheritance, how's your health, are you in a very stable job or a job where your salary is only going to increase. So basically, based on these parameters, your ability to take risk increases. Okay, so you have to decide and figure out, basically sitting with your mutual fund distributor, what is your ability to take risk. Now let's come to the second point. Now let's say you have an amazing ability to take risk, but that doesn't mean that you should put a lot of money into equity market. You also need to look at your willingness to take risk. And what do we mean by willingness to take risk? Willingness to take risk means how sensitive psychologically you are to ups and downs. See, nature and God has made us, all of us, very unique. Okay, and it is not because of uh, it's not because of only one of us. Okay, the nature has built us in a way, right from birth. We, all of us, look at risk very differently. Some people psychologically are very sensitive to ups and downs, and some people psychologically are less sensitive to ups and downs. So you have to understand your own behavior to decide how sensitive you are to a loss. And we all are very unique. Two brothers or siblings, okay, can have different willingness to take risk. Let me explain you, how do you find yourself and how do you figure out your willingness to take risk. And I'll give you a very interesting thought in terms of how do I look at my willingness to take risk. So I just told you about the potential of equity market. The beauty of equity market is that over a longer period of time, it creates amazing wealth. But we also know market goes through volatility. And let me show you by what percentage does market corrects every year. This is data from 1990 to almost till 2021. You will realize these are the falls which you have to go through every year to deal with market volatility. Just as an example, 1990 markets corrected by 30%, 91, 35%, 1992 markets corrected almost 45%. If you look at the entire journey, there are periods when market corrects by 10%, 20%, 30%, and there are certain bad years, horrible years, let's say like 1992 or 2008 or 2001 or during the time of COVID when markets corrected 36%. These are the falls which you can expect from equity market, which happen very frequently. Now you might say, you know what, psychologically, okay, we are all humans. A lot of us cannot see our hard-earned money falling by 30, 40%. Now, what do we do in these circumstances? And that's why you have to figure out what is the willingness to take risk. I will give you my personal example. So my willingness to take risk is that, you know what, I can see a maximum drop of only 20% in my portfolio. So I love to have only 60% of my portfolio into equity, 30% into fixed income, and 10% into gold. And if I do the maths with this logic, 60% into equity, 30% into fixed income, and 10% into gold, Even if market corrects by 30, 40, 50%, my overall portfolio will not fall more than 20%. So this is called as stress testing, that in the worst case scenario, by what percentage my portfolio will fall. That is my willingness to take risk. My ability might be very high. So my ability is very high. I'm around 40 years. My goals are very far. My retirement is around 20 years down the line. My child's education is 20 years down the line. I don't have any short-term goals. So my ability is very high. Husband and wife both are earning. I don't have any liability. I have decent inheritance. So basically my ability is very high, but my willingness is I can only take a 20% hit on my overall portfolio. So I keep it 60% equity, 30% fixed income, and 10% into gold. And that's why you have to look at your ability also, and also look at your willingness. Whichever is the lower, you have to select that. Let's say your ability is high, but your willingness is low, look at your willingness. But on the other hand, if your ability is very low, but for some reason your willingness is very high, look at your ability. I'll give you a very classic example. I met a client who was 55 years old, okay, and he was saving for his daughter's marriage, which is 3 years down the line. So his ability was very less because his daughter's marriage is after 3 years. He wanted to put all his money in equity market. His ability was basically very low, but his willingness was very high. Ability, why low? Because his horizon is only 3 years, but his willingness was he want to increase his money. That's wrong. You have to look at the lower of ability and willingness. So I suggested him to put all this money into fixed income. The idea is you have to look at your ability and you have to look at your willingness and decide basically what should be your equity and fixed income allocation. I'll also tell you, okay, what happens in equity market. Equity market is a journey of ups and downs. Okay, there are periods when for like 3, 4, 5 years, equity market gives no returns. I'll give you a very classic example. And this is where a lot of people lose patience. 2008 to 2014, for almost 5, 6 years, equity market gave zero returns or no returns. But during these times, fixed income gave very good returns. During this time, Indian fixed income market was giving good returns. Gold was giving very good returns. And that's why we tell all the clients, have a combination of equity, fixed income, and gold, because there will be times when equity will not perform. During these times, fixed income and gold will give you a lot of comfort in your portfolio. So ideally, I'll just wrap up what I'm trying to say, that building a portfolio is like driving a car. Okay, there is no right speed in which you can drive. This is a highway. So let's say if you think 60 is a good speed to drive, or 80 is a good speed to drive, or maybe 70 is a good speed to drive, it is very unique to yourself. Don't copy others. Make a plan which is very unique to your goals and your circumstances. So basically, I'll sum it up what we have discussed till now. Okay, the idea of building a financial portfolio is in such a way that you can sleep very well. I've seen a lot of clients who put a lot of money into equity mutual fund, and they're anxious 24/7, thinking that what will happen to the markets and what if markets correct. And that's not the right way of investing. And I also know clients who don't invest into equity markets and are always paranoid. Oh God, I don't have sufficient money for my long term. They're also very paranoid. At the end of the day, you have to do financial planning. You have to do goal-based planning. You have to write down your goals. Be very precise about your goals. Okay. Second is you have to understand equity. You have to understand fixed income. You have to understand gold and have a combination of all three of them. Gold should be around 5 to 10% of your portfolio. Equity mutual funds can vary based on your risk appetite, and then you should have fixed income. You can also invest into international funds, but bulk of your money should be invested into India, because India is an amazing story. Yes, to manage risk, maybe some portion of your money you can also look at internationally. With this, we will end the session, but I'd like to end the session with a very important thought of SIP and the magic of compounding. So people think, you know what, to create wealth, you need a lot of qualification. You need a lot of intelligence. You need a lot of degrees. You need to understand what's happening in politics and everything. And I disagree with all of that. The idea is, this is a very simple example of SIP. Let's say you start a SIP of 5,000 rupees and you continue this SIP for the next 30 years, assuming a 12% return in your SIP. The corpus what you make is around 1.76 crores. On the other hand, somebody who's around 45 years and wants to build the same corpus, he or she will have to invest 7 times more money. So basically, what they are doing is, to get the same corpus, you have to invest 7 times more money. So the hero or the biggest success story happens not because of intelligence. It happens only because of one thing, which is called as time. If you can give time to your returns, to your investments, that's where the magic of compounding happens and you create wealth. One big mistakes which I've generally seen people doing in their investment is that they get too much carried away with the noise which comes in social media, internet, television, radio, magazines. So I'll give you today's problem. A lot of people are scared about equity markets is because there is Russia-Ukraine conflict, maybe a possible recession in the West, problems in UK, China-Taiwan conflict, or maybe people are talking about slowdown in China, or people are talking about high inflation and Fed increasing interest rates. So basically a lot of noise which is there in the market. One thing you have to understand, which I showed you with data, that technically markets correct every year. The world was uncertain, is uncertain, and will always be uncertain. The problems will keep shifting, but equity market over a longer period of time creates wealth, because at the end of the day, businesses are making money. Businesses over a longer period of time create wealth. So you have to ignore noise. Second thing is, you don't have to follow the herd. Don't just do what others are doing. Like we know in last 1 year, what happened? Majority of the clients in the country or across the world invested in cryptocurrency. And why they invested, majority of them? Because they were following others. Idea is, don't follow anyone. Don't just get carried away by what others are doing. Make a unique plan to your goals and your circumstances. Third big mistake, the idea of making easy money. A lot of people get trapped into this derivatives, options, futures, and maybe buying some small cap, mid cap stocks. I've seen thousands of examples like this. In the desire to make easy money, the people lose basically their hard-earned money. You cannot make easy money in markets. All you have to do is goal-based planning and be patient. The last mantra is that, you know what, investment is not about entertainment. It is about goal-based planning. It is about finding your ability to take risks, and it's about patience. Lastly, I've seen there are hundreds of examples. It is not about intelligence. It's not the most intelligent person who makes the wealth in equity markets or is able to achieve their financial goals. It's only about patience, because this game of personal finance is more psychological and less mathematical and economical. The idea is you have to build portfolios in such a way which is based on your goals. It is not a rat race. It is not competing with anyone. It is not about finding the best returns. It is about just achieving all your personal finance goals with least amount of stress. With this, we will end the session, but a simple call of action. You need to have equity stocks in your portfolio, equity mutual funds into your portfolio, large cap, mid cap, small cap, multi cap. You can also add some international funds. For tough times, have some money into liquid funds, gold mutual funds, physical gold. Have something into safety, fixed deposits, debt mutual funds. Have a life insurance, have a health insurance, and keep some money for emergency. With this, we will end the session.
Thanks for your detailed answer. If you have any questions related to this or any other investment options or related to your financial goals, feel free to book a free appointment with our financial planner. The link to the free booking is given in the description below this video. Also, will you be interested to attend insightful investment webinars? Then feel free to register for our upcoming insightful enlightening investment webinar, and it is completely free. The registration link for the upcoming webinar is also given in the description box. If you like this video, please give a thumbs up. Also share it in your social circle. If you are not subscribed to our YouTube channel so far, please subscribe now. Bye.